And now I'd like to invite Neelkanth Mishra, Credit Suisse, who's going to be with us on this edition of The Market, joining us exactly a day after the RBI Governor Shaktikanta Das addressed the nation with the monetary policy outcome. Good morning. Should we begin with the monetary policy, which we saw the reaction for in the markets, whether the all-time low closing for the rupee, the way the bond yields reacted as well, and of course the equity markets. The inflation forecast 6.7%, while growth forecast is also being retained. How are we supposed to see all of this together? There's going to be tightening, there's going to be inflation, but growth stays intact.
So I think the increase in the inflation forecasts to a large extent I would call backward looking. The year-on-year changes in inflation are a very slow moving indicator. I think a more prudent approach when we are thinking about markets is to look at inflationary impulses. And the best way to do that is to look at month on month and whether the inflation is above seasonal or not, and where the new inflationary impulses are coming. Because of the Russia-Ukraine conflict, oil prices have gone up 50-60%. Global food prices have gone up meaningfully, edible oil in particular. And what that means is that there is a step jump in prices. That step jump in prices will keep inflating the year-on-year numbers. But I think what matters a lot more is the incremental inflationary impulses. And in our view, at least at a local level, those impulses are not really that material and worrying yet. On the growth side, I think the growth numbers that RBI has put out are perhaps too conservative. I also believe that the consensus growth forecasts, which are somewhat closer to the RBI's forecasts, are also very conservative. I think the growth momentum in the economy is quite strong, and those numbers can be beaten quite handsomely. In fact, the 4% odd growth that consensus and RBI are projecting for the March quarter next year, in particular, looks too low to me.
Okay, that seems to be the consensus among the experts as well when we talk about the growth numbers. Now, having said all of this, Neelkanth Mishra, what is one seeing when they look at the bond markets? From Mr. Schiller to Bill Winters, the global CEO of Standard Chartered, overnight we're hearing commentary coming in that recession is looking very possible, maybe in the early start of the next calendar year in 2023. The way the bond markets, what they're indicating, the very fact that government has been, off record at least saying these kind of bond yields are not sustainable. Are you looking forward to any kind of jugalbandi between the RBI and North Block when it comes to the bond yields?
So you mentioned the US bond yields and the American economy. And of course, your question was on what's likely to happen or should happen in India. So let's take the US part first. The US policy post-COVID, now it's becoming reasonably clear. And of course, in hindsight, everything is very clear. It was excessive, right? So the stimulus that they gave was far in excess of what was needed. And as a result, they have created global goods shortages because the demand just went 10 standard deviations above normal. And that created pressures in the global shipping supply chains and a lot of other disruptions. The good thing is that those disruptions are now reversing. So we are already hearing of foundries, so the chip supply shortages that everyone talks about. Imagine that some types of chips and some types of foundries are actually now seeing utilization drop below 95%, which is still very high, but given the perception of chip shortages, that's a remarkable statistic. We are now seeing handset companies in Vietnam bringing down the number of days of operations from 5-7 days to 3 days because there is so much surplus inventory. So on the good side, I think the supply chains are the bullwhip is starting to invert very sharply, and I think that inflation will come off. But in the US, there is another problem that the Fed needs to address, which is the wage price spiral. And that hits services a lot more. So in order to break that, which means that when prices go up, then wages need to go up. and therefore, as wages have gone up, then the prices need to go up again. So that spiral is something that I think the Fed wants to break. They have said that. And in order to do that, they may need to keep bond yields a lot higher than they need to, than perhaps they would otherwise. In India, we don't have that problem. So now coming to the Indian issue, so US services inflation doesn't bother anyone. I mean, it shouldn't bother anyone. Goods inflation in the US hits everyone. Goods are very freely traded. So if prices are high in the US, they will be high everywhere in the world as well. If prices of services in the US are high, it doesn't matter that much. I mean, theoretically, it may to a small extent, but taxi rides or some restaurant eating in New York becoming more expensive does not really bother us here. In India, the indicator of sticky inflation, say wages, they're not going up. I mean, outside of a few pockets, which are a very small part of the labor market, which is IT services, I don't think there is any evidence for sustained wage pressures. In fact, the demand for Narega wages or Narega work is actually still higher than it was pre-COVID. Thankfully, it has come down a lot in terms of it's only about 20 lakh ahead of pre-COVID levels. But rural wage growth is still under control. I don't think there is any evidence of sticky inflation in India. The bigger challenge for us, and you brought up the issue of the rupee as well, the bigger challenge for India is the balance of payments deficit. Now, at May trade deficit, which on a seasonally adjusted annualized level was as high as $330 billion, the balance of payment deficit is unsustainable, and we need to address that. The RBI so far has chosen to raise rates, whereas I think perhaps a better outcome may emerge out of a weaker rupee. And because, when you raise rates, you slow down the whole economy in order to attempt to bring down imports by a bit. I think it's a much more directed approach and much more efficient approach, in my view, if you let the rupee weaken, and that then raises import prices, and then imported goods start slowing down. I think in the next 3 to 4 months, we may see the rupee weakening a lot more because our import basket has been hurt very badly because of higher energy prices. Not just oil, but coal is expensive, edible oil is expensive, fertilizers are expensive, gas is expensive. And that adjustment is, I think, the more important one. In order to do that, I think the rupee weakness is perhaps more important. It will actually boost or increase headline inflation for a while. It will be another step jump because imported goods will become more expensive. But I think monetary policy can seek to look through that, right? There is some concern around inflation expectations becoming sticky at a higher level. But I think an impulse which comes from a necessary weakening of the rupee can be looked through when you're thinking about monetary policy. So from a rates perspective, I see less of a justification of increases beyond what I would call rate normalization. So now that COVID restrictions are mostly eased, the recent wave is a bit of a concern, but mostly the restrictions have eased. As the economy has normalized, there's no reason for the RBI to say supremely accommodative and keep repo rates well below what they were pre-COVID. But as we think about the economy, say over the next year or so, having rates meaningfully higher than what they were pre-COVID is also, I think, unwarranted at this stage, because a lot of the impulses in inflation are global, and they will keep the year-on-year numbers inflated for much longer than we may be comfortable with. But we need to understand sequential inflation impulses and look at local impulses as we think about local rates.
Neelkanth, hi, Aisha as well joining in, and I want you to keep your economist hat on for a while. You made a couple of interesting points there. So tell me, how does the BOP deficit issue get resolved then?
Yeah, so there are 3 ways of addressing a BOP deficit. The first is to increase exports, which I think is happening to some extent, but as you can imagine, you cannot suddenly, if your BOP deficit is $60 billion, you cannot suddenly raise exports by $60 billion. It will happen over 3-4 years, but I think it's very hard to adjust it very quickly. The second is to get more capital. So we can get inclusion in the bond indices, like the global bond indices, and that would bring in $30-40 billion in 1 year. We can decide to step up that process. And the third, because even that, actually, given what has happened to global markets and what is likely to happen to global markets, given that, in our view, the Asia Pacific earnings will see downgrades, and they may be led by hardware, technology, and materials, metals in particular. But as that happens, I think it'll create more disruption. So I think the portfolio flows to emerging markets, and we are anchored to, because a large part of flows that come to India are through the emerging market funds or Asia funds. So if there is concern there, I think it is very unlikely that capital flows will pick up by themselves. And even the FDI flows, which is the private equity venture capital type of flows, which were dominating flows in the last 3-4 years, I think are likely to slow down for various reasons that I think have been now well publicized. So getting more capital in is going to be a challenge, other than the inclusion in global bond indices. That brings you to the issue of reducing imports. Now, when you reduce imports, you can choose to reduce only the imports of what has seen higher increases in prices. But the problem there is that if you bring down energy import volumes that meaningfully, it will really badly hurt domestic GDP, because you cannot grow GDP without using dense forms of energy, right? If you want to move faster, you want to automate, you want to use computers, you want to have a better climate control in your house or in your car, you need, or in your train, you need more energy. So the best way to do that, and see, there is no good option, right? People have questioned, oh, are you saying that imported goods should all become expensive? The poor man's household will be hurt. That is a sad reality. The problem is that we are dependent on imported energy. It has become substantially more expensive than it used to be. And therefore, it is important to change our import basket. So if you can't and we shouldn't be bringing down our imported energy by that volume, then we need to bring down the imported avocados. We need to bring down the imported blueberries. And I know those small numbers, but wherever we are dependent on imports, which are to a slight extent discretionary, we need to bring down those imports. And how do you do that? You cannot tell someone to stop having imported avocados or imported apples. You need to let prices go up, and those prices then become the signal that force down the consumption, and people switch to domestic avocados. Now those are available. We can question the quality of them, but the point is that that transition and then a weaker currency will also support exports over a period of time, and that's a much healthier correction. The rupee, in fact, the real effective exchange rate has actually strengthened marginally. It has not changed much over the last year or so. In fact, against the US dollar, the rupee over the last 3 months is one of the strongest currencies. And the only currencies that are stronger are that of commodity exporters. So that's I don't think, a very prudent level to maintain. And letting the rupee drift down a bit is going to be very helpful for making those adjustments.
Neelkant, I sense a tactical shift in your diet. We're talking avocados, we're talking cranberries, and I'm sure there's quinoa as well in there.
No, there's none of that. I like my roti sabji, but those are examples which may appeal to investors who I think have gained in prosperity over the last 2 years.
I get that. I was just poking you. But tell me, let's talk about capital flows, and let's address our equity market watchers as well here. I was reading a very interesting note from you wherein you said that you're recommending using the pause in global sell-off, and I like the fact that you're admitting that India is not alone in this. This is very much a global sell-off. Add to defensive positions. Having said that, in that note, the entire definition of traditional defensives, which is, your IT pharma, is something completely different. I mean, here you're recommending telecom, utilities, etc.
Yeah, so no, thank you for that question. And the traditional approach, and most investors do get surprised that you're calling for a weaker rupee, and then why are you underweight IT services? Because that is and it's a great sector, right? So if you think about it fundamentally, it's a great sector to be in when there is a global macro uncertainty, right? So for example, there is a global tech sell-off, which perhaps may happen. Then the sectors which deal with inventory would be the worst affected, right? That's where the supply chain bullwhip when it lashes downward, makes things very panicky. But there are no inventories in services. So the downgrade would be from, say, 10-12% growth to 8-10% growth, or maybe 6 to 8% growth in terms of dollar revenues. And they have great balance sheets, they have great cash flows, they have supreme quality management, great corporate governance. So everything is very attractive. The problem is it's a very expensive sector. The second problem is that it is also seeing a challenge which it has not seen ever. Right? So it had first claims on the best quality IT talent that India produced. I mean, there were large global software companies and some very tech-focused startups, well-funded, which used to get, of course, the better quality engineers early on as well, and they paid a hefty sum for that. But as the software as a service boom in India develops, and which is fantastic for the country, because we are now starting to move from plain vanilla just services and not owning the IP to starting to own the IP. And as the software world shifts to more software as a service, this is a great opportunity, right? And it's a great thing for India. The challenge is that if the offshore IT engineer delivers $35,000-$40,000 annually in revenue, about $17-$18 per hour and about 2,000 hours a year, the SaaS company is generating $80,000 to $100,000 per software engineer. And therefore, their ability to pay is that much more. And this is an issue we've been flagging over the last year and a half, that I think the business structure, the business model of what IT services companies pay, and therefore what revenues they generate, is going to come under pressure. And as these two adjustments happen, and you see this downgrade of growth from a very, very marginal downgrade, right? So it used to be 5-6%, went up to 12-15%. It's now, I think, 10-12, and maybe it'll need to fall to 6-8. You will see a necessary downgrade in P multiple. So that's why we are underweight IT services. In healthcare, we've started to add weights because it's a very cheap sector. It is very, it's not very cheap. It has become cheaper. It has underperformed for many years now. And the challenge, of course, is it's a very stock-specific sector. But again, very defensive characteristics, and therefore we have gone overweight. In telecom, that's one of the few sectors where there is where the cycle is asynchronous to the GDP cycle, or has been, right? So 2016 onwards, brutal price cuts, complete shakeout in the industry. 1.5, 2 years back, decision to let 3 private players sustain. That brings price stability, provides some stability in earnings. Utilities, again, wish we had added to some of them earlier. They've done very well. I think the fear was that thermal power capacity will just become obsolete in 4 years, 5 years, 7 years. And I think what has happened, though the earnings may not go up much, the sustenance of how long India will need thermal power, I think those timelines have extended, and which is why I think coal miners and thermal power generators may be a slightly safer place to be. We've also added, in the same note that you mentioned, beneficiaries of the shortage of rail capacity. So, truck transport. See, for during COVID, when passenger trains were shut, freight was moving at 2.5 times the speed it used to pre-COVID. And that allowed the railways to gain share. So even on 150, 200 kilometer stretches, it was gaining share. And what has happened once the passenger trains have restarted is that the freight speed has gone down again. And so you need more rakes. Now there's a shortage of rakes. Now the railways cannot deal with, and so therefore the share they were gaining from road traffic, road freight, is now being ceded again. That's great for truck manufacturers. We are also observing that there are a lot of trains getting cancelled. Now this may be, I think, a May-June phenomenon, because that's when the heat is the most, power demand is the strongest, and there is no idle power, or very little idle power. July onwards, hopefully that will ease. But while that happens, I think it's great for pricing power for airlines. So again, very counterintuitively, that you have higher oil prices, you have a weaker rupee, or potentially weaker rupee, and why are you going overweight airlines? And we've been overweight airlines because they have the pricing power. Because even if 1% of rail passengers, because the trains are getting cancelled or becoming more unpredictable, shift to airlines, that gives them tremendous pricing power. Right? Look at the number of passengers by air and by rail. So I think all of those are places where we can reasonably well hide in as we go through what I think will be a turbulent phase for global markets.
Quite interesting. Neelkanth, I must say that next time you got to come to office and we need to have a 1 hour long chat. I mean, commercial obligations. Yeah, okay. Yes, we will definitely treat you to Indian avocados and berries.
Look forward to that.
Okay, great chatting with you. Thank you so much for taking the time out.
Thank you. Bye.
Bye.